The Korean stock market has gone insane. On July 28th, the KOSPI dropped 11%. The moment the drop passed 8%, all trading froze for 20 minutes. This is called the circuit breaker. The next day, July 29th, frozen again. 2 circuit breakers in a row. This has never happened in the market history of Korea. 2 days and 16% of the entire market wiped. In July alone, the KOSPI lost 29%. The worst month for Korean stocks since 1990s. Worse than the IMF crisis. Worse than the 2008 financial crisis. The dot-com bust, COVID, none of them gave a market shock this big. And at the center of all of it sits SK Hynix, down 52% from its June peak, cut in half. 2 months ago, everyone was crazy about this stock. Now all of them are crying. And they're turning on stock market TVs. The so-called experts go on air and say, this makes no sense. The market is absurd. The PE ratio is 3 to 4 times. This is way too cheap. So the people buy more. And the stock keeps falling. But does it really make no sense? Is it really, historically, the lowest valuation? Today, I'm going to give you my honest take on why the market experts are bullshit, and what the market has actually paid for Hynix profits through history, and what I personally think about the current market's sentiment. I'm Ko, and welcome to the Korea Report on Korea. Let's dive in. Stock 101. A stock price is profit times the multiple. Profit is the result of the business. The multiple is the price people put on that profit. Basically, it is the number you multiply profit by to get the company's total value. Hynix did not fall because profit fell. Latest quarter, profit came in at about $43.2 billion, an all-time record. Among every listed company on the planet, that is roughly a top 3 or 4 quarterly profit. Profit went up, but market cap went down. So the thing that dropped was the multiple. Again, a multiple is how many years of profit you're paying for the whole company. At a multiple of 10, if profit holds, the company earns back its entire market cap in 10 years. So how do you know if a given multiple is cheap or expensive? There is no absolute answer. What you do is compare against competitors or against your own self. So let's pull up Hynix past and see what the market used to pay for it. This is the average market cap of Hynix year by year. And this is operating profit over the same year. Look at the profit line. It goes up and down hard. In 2023, this company lost $5.5 billion. 2 years later, it earned $34 billion. And in 2018, it earned $15 billion and $1.9 billion at the very next year. $13 billion of profit gone in 12 months. This is what a cyclical industry looks like. And when a business swings this hard, the multiple does something very interesting. Divide each year's average market cap by that year's confirmed profit. In 2018, you get a multiple of 2.7. In 2019, 20.3. The same company swinging between 2.7 and 20 wildly. So is 2.7 cheap and 20 very expensive? Here's the thing. When profit peaks and the outlook turns bad, the record profit sits in the denominator, but the bad outlook gets priced into stock today. So the stock falls while the profit is still glamorous, and the multiple prints its lowest number at the exact moment the business looks its best. The multiple looks cheapest at the top. That is the trap in a cyclical industry. Let's talk in terms of stock returns. 2.7 feels low. So you would think that you'll make money buying that 2.7 because it looks very cheap. The people who bought 2018's cheap 2.7 were down 26% within months. If they bought at the year's high, down 40%. The cloud cycle turned and profit collapsed 87% the following year. And the most expensive looking year in Hynix history, 20.3 in 2019. Those stock buyers were up 56% the next year. By early 2021, they had nearly doubled their money. So basically, for the cycle industry, the absolute number of the multiple tells you nothing. Nothing. So when an expert goes on TV and says the fundamentals are fine, the stock just got hammered, it's 3 times historically cheap. That is all bullshit. So if a multiple is market cap divided by profit, to figure out if today's market cap is low or not, which year's profit do you have to divide by? You have three choices: last year's, already booked numbers, this year's, still in progress, or next year's, the future profit. Logically, measuring today's price against future profit is the most accurate multiple because stock prices move ahead of reality. They price in the future. But there's one problem. The future is the one number you cannot know. The most accurate multiple is the one you cannot compute. That's why in practice, most people settle for this year's multiple, knowable with decent accuracy. The multiple based on past profits is close to useless for cycle industries. We just watch the denominator shrink to 1/7 in a single year. And the more bullish investors reach even further out, they'll pull next year's profit or beyond into the denominator. Then why can't we just estimate next year's profit? Unfortunately, analysts who are paid to predict cannot even predict next quarter. Predicting the future is basically impossible. Most of us don't know what next week looks like. Hynix's own second quarter, announced July 29th, missed consensus by 5% in revenue and operating profit. 3 months out, off by 5%. And somebody's telling you he's going to predict next year or the year after. Not possible. This is how bad analysts are. In 2018, back when 2.7 looked insanely cheap while Hynix was posting record profits, the consensus for next year's profit, or 2019, was $14 billion in November, $12 billion by December, and $10 billion by January. The actual number came in at $1.9 billion, 1/7 of the November estimate. That is your average analyst. So, with all that in the table, let's look at what Hynix is trading at right now. This year's multiple is 3.8. That is today's market cap divided by $193 billion, this year's consensus profit from the Korean brokerages covering this stock. Now, let me ask you again. After seeing the 2018 2.7, does this still feel like nonsense? Does 3.8 still scream way too cheap? Put that 3.8 next to the 2.7 we just saw. Today's multiple is higher than what the market paid at the last cycle's top. So whether Hynix is cheap is not answered by this year's profit at all. It hangs on 2027 and beyond. In other words, investors are demanding proof that reaches further into the future. They're worried that the hyperscalers will cut AI spending. They're worried memory price momentum will fade. For reference, on 2027 consensus, the forward multiple is 2.6. Only there does the number finally slip below that 2.7. Conservative territory at last. But as I said, we can't even see tomorrow. Nailing next year is impossible. That's why your own read on this cycle matters the most. It all comes down to which company you think Hynix became. The 2018 Hynix riding another peak out, or a re-rated Hynix, a structurally different memory business. If you believe AI demand and long-term supply contracts have genuinely changed what a memory maker is, then the crash right here is a real buying opportunity. But the ones who go on TV and read that 3 times multiple as cheap with nothing but the absolute number, honestly, they make me sick. All bullshit. Nobody can predict the future, so you do the next best thing. You listen very, very carefully to the people standing closest to it, the company itself. And with exactly that hope, I sat through the July 29th earnings call as a Hynix shareholder myself. I came away deeply disappointed. There is almost no substance in that conversation. The only hard number the company offered, long-term contracts with about 10 customers, 5-year terms as the baseline. That was it. Ask what share of next year's capacity is actually locked in, they say we can't disclose that. The rest was smoothed over with lines like, we're monitoring market conditions, we're approaching this strategically, like a college group presentation. No numbers, no hard numbers were provided. You know this type of sentence, responding strategically to challenging environment. What does that actually say? Nothing. No number, no commitment, no information. It's the kind of language that treats the listeners like a fool. And the timing could not have been worse. Because right now, the entire market is asking exactly one question. Is this cycle different from 2018? Is the re-rating real? The company mumbled, so the stock got hammered. That's the whole sequence. The market is not stupid. It did not cut Hynix multiple because it's confused or irrational, or because nothing makes sense. The market is rational. It simply can't give faith to a company that won't speak in numbers. Don't get me wrong, I myself am holding a lot of stocks of Hynix. I think part of this crash is technical and it's because of forced selling. I've been buying this dip, including the very day I'm recording this. But that is just a position, not a prediction. Is this 2018 Hynix or a rated one? That answer depends entirely on your view. Thank you for watching the Career Report on Korea. I'm Ko, and I'll see you in the next report.